And welcome to our discussion today on this topic, IFRS 16 leases. This new accounting standard issued by the IASB specifically talks about the treatment for the leases as entered into between two parties, namely the lessee and the lessor, right? Before this accounting standard was issued, we had, of course, an existing accounting standard with the same name called IAS 17. While this IAS 17 leases was sufficient to take care of the accounting for and the disclosures with respect to different types of leases, it still lacked the consistency as was suggested by the conceptual framework, where it talked about, let's say, the use of an asset, as in the recognition of an asset in the books of an entity on the basis of control, and rather it focused upon something like transfer of risk and rewards, right? And that is one reason why the IASB, the International Accounting Standards Board, had to take this option to revamp the existing accounting standard, which is IAS 17, and replace it with the new accounting standard, which is IFRS 16, right? The predominant or the primary impact of, or the requirement of IFRS 16 is that the accounting for leases is predominantly taken through finance lease, right? And when I say I'm looking at finance lease, I would mean to say that the user in general is required to show the asset in his books, right? So the user or the lessee is mandatorily required to show the asset in his books, right? Let's even try to understand why would it happen, or why is it required to be done like that for, let's say, showcasing the right set of accounting here. Let's take an example precisely. The two companies, company X and company Y, right? So let us say they are competitors. It could be any industry. Let us say that we are talking about FMCG. Okay. Now these two companies, there are a lot of investors, a lot of potential investors who would like to evaluate in terms of which company is performing better, right? So we are given this information, which is the sales of company X and company Y, right? Let us say that this amounts to $100,000 in a particular year, and in this case also this comes to $100,000 for the other company as well. Let us say that the investment in assets made by company X is $40,000, and in this case it is $20,000, right? So we have two competitors. The sales information and the investment in assets is also given here. If I were to, let's say, calculate the efficiency, maybe through assets turnover ratio, we are saying this is 100,000 divided by 40,000. This becomes 2.5 times, and in case of company Y, this is 100,000 divided by 20,000, which is of course 5 times here, right? So if I were to, let's say, measure where I would like to make my investments into, I can safely say with the help of these numbers that company was more efficient considering the turnover, right? With the lesser amount of investment in assets, it is able to create 5 times worth of sales, as in case of, let's say, company X, where of course the accounting treatment happens like this, right? So a potential investor or an existing investor, by looking at the P&L and the balance sheet, might draw a conclusion that this company is performing better. So let's do one thing. Let's make investments in this particular organization, right? So that is something which is a normal ratio that we have calculated to, let's say, measure the efficiency of these businesses. But then hang on, let's even try to dig further in terms of what could probably be the add-on information. Let us say that the company Y has some assets on lease. They have taken some assets on rent, and since they have taken these assets on rent, of course they are using these assets in the business, but still not showing these assets in its balance sheet. And as a result of that, what we notice here is, if I say for the sake of it that there are $30,000 worth of shares, $30,000 worth of assets which are not shown in the books of company Y, realistically the total investment would now be 20 plus 30, which is $50,000. And when this happens, my turnover ratio will not be 5 times, but will be taken as 100,000 divided by 50,000, and then it becomes 2 times. And now you realize that company X is a more efficient or a better company to make your investments into, right? So that is something that obviously even been the case with the original concept of finance leases under IAS 17, right? But then the IFRS 16 is a little more stringent accounting standard, which says that a lease is in general a finance lease, right? So if you are entering into any lease agreement, you are usually required to show the assets in your own books, even though you are a user, right, of those assets, right? Why so? Because you would like to bring a consistency, as in when you are using a particular asset. So let's even try to understand this better. When you are using the assets in the business, the benefits are obtained by yourself by making the use of the assets, and you control such use, right? So precisely you're saying that the benefits and control relates to you. So for meeting the conceptual framework of the assets definition, ideally speaking, this asset should be shown in your books rather than the books of the legal owner, right? So precisely the IFRS 16 brings a higher level of consistency while preparing or presenting the financial statements. It adds, of course, more or a better comparability between a company's financial statements with those of its competitor, right? So precisely what you're looking at is, when you're using the asset, when you're using an asset in your business, the benefits and the control relates to you. So ideally, the asset should come in your books. What does that mean? Let's even try to understand that here. What does it mean? It means that you need to, as a user, or a lessee, you are required to show the asset in your books, charge depreciation in your books, right? And most importantly, split the payments or your rentals into the value of the asset and interest amount. You need to show the asset in your books, charge depreciation in your books, and split that amount that you're paying to the owner or the lessor in your books between the value for the asset, the capital amount, and the interest portion, since you are literally you're virtually buying an asset, but you're not paying for that asset on day one. You are deferring this payment over a period of time, and that is where this interest also needs to be recognized in your books, right? And let us even quickly have a look at the impact of such kind of accounting treatment, and then we'll look at the exceptions to the rule in terms of when we do not need to showcase this particular accounting treatment here. The impact, straight away impact here is, many businesses would show or would make a use of something called as EBITDA, right? Earning before interest, tax, depreciation and amortization. Large companies, significant investment into the non-current assets, they would preferably make their valuations done through the EBITDA model rather than looking at only the profitability part of it, right? So it's more of an emphasis upon the operating cash flows coming in. But then hang on, the moment you say that you are by default using a finance lease, it means that an expense which was an operating expense for you before in the manner of or by means of a rent now gets converted into interest and depreciation, because you are not charging a rent anymore in your books. You are rather charging interest and depreciation, which means that your EBITDA changes. There is a delta here, right? So while your rent was, again, looking at the second impact, while your rent was, let's say, uniformly charged over the lease term, you are looking at your installments being split into interest and value of the asset, right? And of course, let's agree further, while depreciation would remain kind of let's say for the sake of convenience, under a straight line method, if I look at the interest, of course it is higher during initial period, which reduces over a period of time. What does it mean? It simply means that while there was an expenditure which was uniformly charged over the lease term, here your expenses will be higher in the or during the initial period and will reduce over a period of time. So that is something which is a clear and of course a potential impact to a significantly higher number of companies. The moment this accounting standard becomes applicable, becomes mandatory, of course a lot of companies would see a big change in their EBITDA, they would see a big change in their turnover ratios, they would see a significant change in their ROCE, the return on capital employed, right? A lot of companies would start showcasing a lot of assets which were otherwise lying off balance sheet, right? It was said by one of the directors of the IASB that he has been traveling a lot around the world and he has not come across any airlines business, any airlines company which shows an aircraft in its books. The very obvious reason why they did not used to show it was that all such aircrafts were always taken on lease, and since the lease accounting standard permitted such companies to not show these assets, not show these aircrafts in the financial statements, but rather charge an expense in form of rentals in the books, their balance sheets appeared literally empty without any assets, and that made a difficult judgment, that made the decision to, let's say, evaluate the balance sheet and let's say the financial position of the company in the absence of such kind of assets in the books of such companies. And that is where this big gap, these so-called as off balance sheet items, they would be now brought into the accounting side of it. And that is where the challenge comes. If you are required to split your rental payments, which was quite a straightforward accounting exercise for you, that is, you would say debit rent expense, credit, let's say, the payment to the the lessor. So it was a clear expense in your books. But now if you are required to split your rental payment between the value of the asset and the interest payment, of course it becomes a little more complex. The accounting becomes a little more difficult, and that is where, of course, we start talking about the exceptions to the rule as to when you are not required to show the lease as a finance lease. So we're going to talk about precisely the exceptions to the rule the standard suggests that you may not do this accounting, right? You may continue to show your expense paid, the amount paid for the the lease that you have taken for the asset, you must continue to show it in your P&L as an operational cost if the lease is a short-term lease and the asset is of a small value, right? So what we are saying here is the two conditions that are required to be met, which says that, let's say, in such cases, the amount paid for lease is charged to the income statement. That is the ease, that's the easy way out. You're paying rent, you're charging it to P&L, end of the story. You're charging it in a systematic manner, uniformly over the lease term, end of it. You're not required to do any complicated accounting when these conditions are met, right? And that is where it becomes significant to understand as to when can you say that a lease is a short-term lease and an asset is of a small value, right? So let's spend some time understanding this in terms of when you do not need to show a lease as a finance lease and of course not required to do any complicated or a complex kind of an accounting, right? So let's talk about the first case first. We are saying that the lease is a short-term lease, right? Let's even try to understand here. The standard specifically says if the term is 12 months or less, right? If I'm entering into a contract to use a particular asset for a period of 12 months or less, it becomes a short-term lease, right? But then, of course, the IASB recognizes that people might want to manipulate. Let's even spend some time here understanding why probably people want to manipulate, right? So if I say that, I'm again talking about those two examples of company X and company Y, where we said that the sales are $100,000 for both the companies, right? The assets are that gives of course a better turnover ratio here, higher ROCE. If I say that, I'm looking at probably the profitability part of it, the EBIT part of it. Of course, company X would always appear better as compared to company Y, but then company Y will appear better because it is showing the lesser amount of assets despite the fact that it still has some other assets worth $30,000 not shown in the balance sheet. So normally companies may not prefer to show the assets in their books, right? But then we are saying that if the lease is a short-term lease only, that is, the lease term is not going to exceed 12 months time, that is where you would want to call it as a short-term lease, and that's one reason why you may be permitted to not show the assets in your books, right? When your intent of getting into the lease is not going to be using it for a longer period of time, and the restriction is quite rigid here. The IASB specifically has focused that if it exceeds 12 months time, it becomes a finance lease. You need to show the asset in your books. But then when you say that it is for 12 months or less, you need to even understand as to what is the meaning of lease term, right? You need to really appreciate what is the meaning of lease term here. Lease term, as per the definition, as per the understanding, says that is the non-cancelable period as per the lease contract. It's a non-cancelable as per the non-cancelable period as per the lease contract, plus any period under an option to extend the lease and it is reasonably certain that the option will be exercised, right? So let's even understand what are we trying to kind of achieve here. What are we trying to kind of get when we look at this particular statement here? We are saying that there is a company X enters into a lease of 6 months, right? It enters into a lease of 6 months, and the contract allows to extend the lease by another 1 year, right? Where company X is required to only pay $1 per month against market rent of $1,000 per month for future period, right? So we are saying company X enters into a lease of 6 months. This appears to be the non-cancelable period of 6 months time, but should I call it as a short term? Maybe yes, if of course the company X enters into a short term lease and says that I do not want to show the asset in my books, because if I do so, my efficiency ratios, the value of my business may go negative, right? So when I say that company X enters into a lease of 6 months time, this 6 months is apparently a short term period, but then the contract says you can extend the lease, you can further increase the period by another 1 year, and the company X is given this option, as in where it may only be required to pay $1 per month, whereas the monthly rental is, let us say, $1,000 per month. So it is quite clear at the start of the contract itself. It is quite clear at the beginning of the contract itself that yes, company X is going to extend these lease. The company X is going to exercise this option. Why not? You're only required to pay this amount while the market rent is likely to be $1,000 per month. So that means that this lease term is not for 6 months, but at least 1.5 years, and the moment it happens, you would need to show such an asset in your books because the treatment would be done under the finance lease, right? Please also bear it in mind that the lease term includes any free period. So if, let us say, company X is given, you use this asset for the first 3 months and then you can get into a lease for the next 6 months, and then there is an extension period also, then those 3 months of free period is also added to that lease term to be able to determine whether it's a short-term lease or not, right? So that is something we wanted to cover in this particular discussion. The next discussion we're going to discuss is precisely understanding what is a low value asset for us, right? So that is something which is the point of concern in this new accounting standard IFRS 16, which talks about the accounting treatment of leases, predominantly in general finance leases, right? So that is something which we are going to do or discuss over these sessions in the future lessons. Good so far? So keep watching these videos and good luck with your preparation. Have a good day.